Okay, let's unpack this. Have you ever wondered if the most notoriously expensive housing markets could actually, well, correct themselves? For years, San Francisco seemed to defy gravity, didn't it?
It really did, like it played by its own rules.
Exactly. A housing market that just kept soaring, seemingly untouchable. It was almost, an article of faith. Bay Area real estate always goes up.
Mm-hmm. That was the narrative.
But what if that bedrock belief is, well, actually crumbling right now? Today, we're diving deep into the San Francisco housing market.
Oh.
And the latest data isn't just hinting at a correction anymore. It's practically screaming it from the rooftops.
Yeah, the signals are pretty strong now. Unmistakable, really.
So the big question isn't just if this giant is adjusting, but how much more could it fall? And maybe, just maybe, when might it become accessible again for people who've been locked out for so long?
That's the core of it, isn't it? Affordability.
We're setting the stage for what looks like a really dramatic shift in supply and demand. A seismic change, really, that's hitting not just the Bay Area, but all over Northern California. And here's where it gets really compelling for you, whether you're thinking about buying or you already own a home there, or maybe you're just fascinated by these market swings.
Right.
We're going to meticulously explore why homes are suddenly piling up like this, why buyers seem to have vanished, and what history, specifically that last big housing crash, can tell us about the potential downside.
It's crucial context.
Yeah, get ready. The picture might genuinely surprise you.
What's fascinating here, I think, is just how quickly the landscape can pivot. Even in markets everyone thought were completely untouchable.
Like San Francisco.
For decades, it had this aura, this exceptionalism, like it operated outside normal economics. But what we're seeing now is just fundamental economic principles reasserting themselves. Supply and demand, they govern every other market, and well, it turns out they govern the Bay Area, too.
No market exists in a vacuum.
Right. Precisely. It's a stark reminder. So we'll be connecting the dots. You've got this dramatic surge in homes for sale, this equally dramatic drop in buyers.
A real mismatch.
Huge mismatch. And then the surprising realities of home values, not just in, say, SF County, but across the whole region. And this raises that crucial question for you. What does all this data actually mean for your plans? Are you looking to buy? Thinking of selling, or just trying to get your head around one of the nation's most talked about and, frankly, volatile housing market?
Yeah, understanding it is key right now.
The insights we're about to share offer a very clear picture, and maybe for some, quite a surprising one.
So let's start with the ground zero of this shift, inventory. For so long, the story was scarcity, wasn't it?
Absolutely. Chronic undersupply.
Yeah.
Not enough homes for the demand, especially with tech booming.
Right. That narrative, it hasn't just shifted. It's completely flipped on its head. The numbers here are, well, they're pretty startling. Over the last 2 years, the number of homes for sale in the SF Metro, it's more than doubled.
Doubled. That's a huge jump in just 24 months.
Think about that. Twice as many properties hitting the market. We're now seeing well over 7,000 active listings across the whole metro region.
Wow.
And to put that in context, historically speaking, that's the highest level of homes on the market in almost a full decade.
Nearly 10 years, so this isn't just a blip.
No, not at all. It's a supply explosion, something we haven't seen in a very, very long time in this specific, usually tight region. And crucially, this isn't just like one struggling neighborhood or a few pockets. This piling up of inventory, this massive surge, it's happening pretty much uniformly across all the key counties.
Right across the board, then.
Yeah. We're talking San Francisco County itself,
Yeah.
the dense city core, but also Marin County up north, affluent communities, Alameda County to the east, Oakland, Berkeley, and Contra Costa County, too, places like Walnut Creek, Concord. Every single one is seeing this dramatic, sustained increase in homes just sitting there.
So it's widespread.
It really is. And such a massive volume of available properties.
Yeah.
Well, it's forcing sellers to do something they haven't really considered in what feels like forever. Cut prices.
The dynamic has shifted.
Completely. Those days of multiple, aggressive, over-asking offers, waiving contingencies, they feel like a distant memory now.
Yeah, that frenzy is gone.
When you as a buyer have thousands of properties to choose from and way fewer serious buyers competing, the power shifts decisively.
Buyers are in the driver's seat, relatively speaking.
Sellers just can't hold out for those peak 2021, 2022 prices anymore. They're having to adjust. It's a clear sign the market's flipped from a seller's dream to something much tougher. A buyer's market, maybe?
Or at least moving strongly in that direction. If we connect this to the bigger economic picture, this inventory surge, It's a direct result of that fundamental imbalance we talked about.
Too many sellers, not enough buyers.
Exactly. When you have so many sellers trying to offload properties, maybe feeling some urgency, and so few buyers actually able or willing to commit, the market just shifts aggressively towards the buyer.
Basic economics, really.
Textbook. Increased supply, diminished demand. Prices go down. The law of supply and demand is hitting hard even in the Bay Area. It's also important to understand the seller's psychology here, especially after such a long, hot run.
Right, they don't just slash prices overnight.
Generally, no. It's more gradual, often painful. A seller might list thinking about peak 2022 values. A totally different world.
Holding on to that recent memory.
Exactly. Then the property sits. Weeks, maybe months. Little interest, so maybe they relist a bit lower. Or new listings come on, still kind of aspirational, too high for today's buyers. It's a slow burn of realization for many.
Psychological inertia, you called it.
Kind of. They're clinging to that peak memory, slowly, maybe reluctantly, adjusting to the new normal. And that adjustment period itself, it adds to the inventory pileup because homes sit longer. So this situation is a really powerful illustration of supply just overwhelming demand. And that always puts downward pressure on values.
Always.
But it's not just about more homes. It's crucially about how many people can actually afford to buy them.
Right. The affordability piece is key.
You can have thousands of homes listed, but if only a fraction of potential buyers can make the numbers work, especially with today's interest rates, that inventory just keeps piling up.
And that signals more correction to come.
It's a very strong signal, yes. It clearly indicates further market corrections aren't just possible, they're highly probable. It's definitive proof the market's shifted from that seller's paradise to a much tougher environment for them, with more room to potentially fall.
So, okay, one side of the ledger, this massive surge in supply, but that's only half of it.
Right.
The other side is demand. And, well, you said it earlier, it seems to have fallen off a cliff.
It's a dramatic drop, no question.
When we talk about a full-scale correction, it's rarely just one thing, is it? It's usually a mix of forces.
Almost always. A confluence, as you said.
Here, it feels like the rising supply hitting a wall of collapsing demand.
That's a good way to put it. They're colliding head-on.
Let's break down that affordability crunch, because it really is at the heart of this demand collapse. The typical home value in the SF Metro, still around $1.2 million.
Still incredibly high, second highest in the U.S.
Just let that sink in. $1.2 million. Now, layer on top of that, mortgage rates stubbornly sitting around 7%.
Ouch. That combination is brutal.
It creates this huge financial hurdle, almost insurmountable for many, especially if you need a mortgage. So, quite simply, if you're a typical earner, can you genuinely afford that? A $1.2 million house at 7%.
For the vast majority, the answer is just no.
Even with a good six-figure income, that monthly payment, you mentioned $7,700 earlier.
Around that, yeah. And that's before taxes, insurance, maintenance.
Which are not cheap in California.
Definitely not. So the total monthly outlay is staggering. It's just out of reach for most household budgets, even in a high-earning place like the Bay Area.
And this affordability crunch is just crippling buyer activity.
It absolutely is. It's draining the lifeblood out of the market.
And the data backs this up pretty starkly. You mentioned April 2025 figures. Only about 2,600 home sales across the entire Bay Area.
Roughly, yeah. Which sounds like a lot, but context is everything.
Right. Put that in perspective. How does it compare?
Well, it's down a whopping 40% from the peak during the pandemic in 2021.
40%. That was when things were red hot.
Exactly. Low rates, tech, booming. But maybe even more telling, it's about 22% below the long-term historical average for sales in the region.
So it's not just down from the crazy peak, it's below normal levels too.
Significantly below normal. This isn't a temporary dip. It's a sustained, deep contraction in buyer activity. It signals a market in, well, pretty deep distress. It's undergoing a profound reevaluation. Which leads us to ask, why aren't people buying? Even with more choice.
Yeah. What's holding them back besides the obvious cost?
Well, the cost is the main thing, let's be clear. It's that combination. The sheer height of prices, still near historic highs despite the drops, coupled with those elevated interest rates.
Rates a barrier.
An immense barrier to entry for almost everyone who needs a mortgage. To comfortably afford $1.2 million, even with a big down payment, you need an exceptionally high income. Mid-six figures. Easily.
And not enough people have that, even there.
Not enough to sustain the previous level of demand. So demand evaporates. And we're seeing this interesting dynamic now, this standoff between sellers and buyers.
Seller reluctance versus buyer hesitation.
Exactly. The data shows sellers are starting to feel the pressure. Anxiety, maybe. Declining sales, homes sitting longer. They're realizing the easy times are over. Buyers, though, they're in a stronger position. More options, less competition, more leverage. But they're being extremely cautious.
Waiting to see if prices fall further.
Precisely. They're sensing the downward momentum. Nobody wants to, catch a falling knife. Buy today and watch the value drop 10% tomorrow.
That's the fear.
It creates a stalemate. Homes sit even longer. Deals are harder to close, which just adds to that inventory pileup we discussed earlier. And we're seeing powerful real-world examples of this all over the Bay Area.
Like that Berkeley property you mentioned.
Yeah, take that Berkeley house. 3-bed, 2-bath. Listed just under $1,995,000. Seems premium at $761 a square foot, right?
Sounds like it.
But here's the kicker. It's only appreciated 31% total over the last 17 years. Since 2008.
17 years. Only 31%.
Works out to less than 2% a year average appreciation in Berkeley.
Wow. That really goes against the grain, doesn't it? The idea that everything just shoots up.
Completely debunks it. It shows not all properties are equal, and some have been lagging for a while. Their slower growth just hidden by the overall boom. Now it's being revealed. Or take that even more extreme example, the San Francisco condo, 3-bed, 3-bath, listed now for $1.2 million.
Okay.
What's striking is its recent history. Back in 2021, at the peak, it was valued around $1.8 million.
So that's a huge drop already, like 30%.
A massive, undeniable 30% drop. But wait, there's more.
No.
The previous owner actually bought it just last year, in 2024, for $1.2 million. And they're already trying to sell it for the exact same price.
Trying to flip it for no gain in this market.
Good luck, right. You'd predict they'll have an incredibly hard time. They might even take a loss after closing costs.
Yeah, that sounds rough.
These aren't just abstract numbers. They're real people's investments, their decisions, their hopes, maybe being dashed. It shows significant, painful shifts.
It really underscores that values aren't just starting to correct. They have been correcting for a while now. And sometimes quite dramatically.
Challenging that whole notion of SF real estate invincibility.
Absolutely. And like you said, this isn't brand new. It's been happening for a bit now. Home values across the metro have been declining. How long did you say?
For the last 2.5 years, pretty steadily.
2.5 years. So it's a sustained decline, not just a sudden blip, a consistent erosion of value.
Exactly. A prolonged correction.
And overall, for the whole metro, values are down 8.1% from the 2022 peak.
That's the overall figure, yes.
Now, 8.1% might not sound like the sky is falling, especially after the huge run-up.
Yeah.
But you're saying that's actually a big deal nationally.
It is. It's one of the highest corrections among all large metro areas in the U.S. It puts the Bay Area right at the forefront of the national housing slowdown.
Which is a real turnaround for a market that usually leads on the way up.
A significant turnaround, yes.
Now, when we drill down, these drops aren't the same everywhere, are they?
No, definitely not uniform. The impact varies county by county.
So where's it been hit hardest?
San Francisco County itself, the city core, that's seen the biggest drop, double digits, down a staggering 14.5% since mid-2022.
14.5%. Wow. So even though it's still crazy expensive,
yeah,
typical value $1.3 million.
Still incredibly expensive, yes.
That's a considerable saving compared to 2 years ago. A huge shift for such a pricey market.
It absolutely is. A $1.3 million home is significantly cheaper than a $1.5 million home, relatively speaking.
Okay, what about the surrounding areas? Alameda County, Oakland, Berkeley.
Alameda is down 6.5%.
And Contra Costa. Walnut Creek, Concord.
Contra Costa has seen an 8.8% drop.
Marin County up north.
Marin is down 8.1%, similar to the overall metro average.
And San Mateo south of the city, Silicon Valley adjacent.
San Mateo County is down 6.6%. So substantial drops across the board, but definitely varying degrees.
Reflecting local conditions, I guess.
Local supply, demand, economic drivers, yes.
But there was one outlier, wasn't there? Santa Clara County, Silicon Valley Central.
That's right. Santa Clara, home to San Jose, Apple, Google. It had actually seen values increase over the last 3 years. It stood out.
Seemed immune for a while.
It did. But even there, the tide seems to be turning.
What's happening now?
The data now shows inventory in Santa Clara is rising sharply, just like everywhere else.
Leading indicator.
Exactly. It strongly suggests that even this powerhouse market might not be immune to the broader regional pressures for much longer. The dominoes seem to be reaching even there. And this expansion into Santa Clara, it makes us look at the broader implications.
Yeah, is it just a Bay Area story or bigger?
It's definitely bigger. This isn't just localized to SF and its immediate neighbors. If you look at monthly value growth across all of Northern California,
What do you see?
values are dropping pretty much everywhere. The trends we're seeing in the Bay Area are mirroring themselves across the entire northern part of the state, a widespread regional adjustment.
So that includes Santa Clara now.
Yes, which was the holdout,
Yeah.
but also places like San Joaquin County, Stockton, Sacramento County, areas people maybe fled to for affordability.
Even those are correcting now.
Yes, and even historically more stable spots like Sonoma and Napa counties, the wine country, they're starting to see notable corrections too.
Wow. So it's really region-wide. What's driving that? Same factors.
Pretty much. Similar surges in inventory everywhere, colliding with that collapsing buyer demand across the entire region. It shows how interconnected these markets are and how vulnerable to the big economic forces. The fundamental principle here is just so clear. Housing is supply and demand.
Simple as that sometimes.
More listings, fewer buyers, prices adjust, usually downwards in this scenario.
So for you, the listener, if you're a buyer, this surge in inventory looks like good news.
On the surface, yes. It signals a much more favorable market for buyers, more choice, potential for better deals, and definitely more negotiating power than you've had in years.
The bidding wars are over.
Mostly, yes. That era seems to be behind us for now. However, there's always a however, isn't there?
Always. What's the caution?
You need to be prudent, aware of the risks. While you might get a better deal now compared to a year ago, there's that risk the market keeps falling after you buy.
Catching that falling knife.
Exactly. You could buy today, and maybe it drops another 10% or more. That's a real risk intelligent buyers try to manage.
So how do you manage that?
Data. Understanding the detailed hyperlocal data for your specific area is absolutely crucial. Don't just jump in because prices are off the peak. Know your specific market's trajectory.
Timing is tough, but data helps.
Data is key to navigating this volatility. And a really helpful way to grasp this is through that metric we call inventory surplus, or deficit.
All right, explain that again. It's not just the raw number of listings.
No, it's smarter than that. It compares current inventory to the long-term normal level for that specific month, and it's adjusted for seasonality. So it tells you how much extra supply is really out there compared to what's historically typical.
Gives a clearer picture of the imbalance.
A much clearer picture. And right now, we're seeing overwhelming inventory surplus almost everywhere in Northern California. Let's look at some specifics. Marin County. The inventory surplus is 46%.
Meaning nearly half as many homes again as usual.
Pretty much. Normally about 419 homes on market this time of year. Now it's 612.
Okay. What about Contra Costa?
Typically sees about 1,400 homes in May. Now, 2,200.
Alameda County, Oakland?
Usually around 1,300 currently.
Right.
An astonishing 2,300 homes. Inventory has exploded there, nearly double the norm.
Wow, that's huge.
Wow.
Even Stockton.
Even Stockton. Normally around 900 homes, now 1,300 listings. It's undeniable evidence of oversupply putting pressure on prices everywhere. And this massive inventory growth, it's directly hitting the price forecasts for the next year.
Giving us a glimpse of where things might be heading.
Exactly. For example, San Joaquin County, Stockton, projected to see values drop another 4.3% over the next 12 months.
Okay.
And Alameda County, with that exploding inventory, the forecast is even steeper, a downward trend of 6.7% over the next year.
These aren't small adjustments in such expensive markets.
Not at all. They reflect the sheer weight of this excess inventory. So for you, the listener, understanding this, the market isn't just subtly shifting, it's actively, demonstrably moving down. And knowing that empowers your decisions.
Yeah, you often hear this idea, maybe from real estate agents sometimes, that Bay Area values never go down, that buying here is a guarantee.
Oh yeah, that myth is persistent.
It's just not true, is it, looking back?
Absolutely not true. While yes, values have gone up a lot over the long term, especially during tech booms, the historical data tells a much more volatile story. This market can and has gone down significantly.
Let's remind people about the last big crash,
Yes.
2007 to 2012. The Bay Area wasn't immune then.
Far from it. It was hit hard. Deep, painful corrections for many.
What were the numbers? San Francisco itself.
In SF proper, values plummeted 32% during that downturn. The typical home went from about $657,000 down to $445,000.
32%. That's a massive hit to equity.
Huge. And it was even worse percentage-wise in some nearby areas.
Like Stockton.
Stockton saw a truly massive 63% drop. Values were more than cut in half.
63%. And Sacramento.
Sacramento experienced a painful 48% decline.
So look, we're not saying it's going to be that bad this time.
Nobody knows for sure, but the point is...
The point is, this market is volatile. It has a proven downside. Lots of people got hurt financially last time around. Foreclosures, negative equity, buying into that never goes down myth was costly.
It's crucial to remember that history. It's not immune.
Right. Now, of course, values did eventually bounce back after that crash, and they soared way past previous peaks, leading to the highs of 2022 before this current correction started.
That's true. The recovery was strong.
But even with the recent drops we've talked about, prices are still incredibly high. That $1.1 million typical value? It brings us back to that fundamental question. Who can actually afford to buy here now?
Exactly. Which brings us squarely back to affordability. Who realistically can buy in the Bay Area today?
With that $1.1 million typical value and the $7,700 monthly payment before taxes and insurance.
It illustrates the immense ongoing affordability crisis. It hasn't gone away just because prices dipped 8 or 10%.
Still incredibly expensive.
And crucially, most buyers aren't paying cash. They need mortgages.
What are the stats on that?
In San Francisco proper, 73% of buyers use a mortgage. Only 28% use cash.
3/4 need financing.
And in San Jose, it's even higher. 82% use a mortgage, only 18% cash.
Wow, so this market's hugely dependent on debt.
Profoundly dependent on the availability and affordability of debt, which makes it incredibly sensitive to interest rates.
When rates go up, like they have.
The pool of buyers just shrinks rapidly. The monthly payment becomes impossible for too many people. They simply can't afford to service a loan for a $1.1 or $1.2 million home without affordable debt. Without it, demand just crumbles.
So as long as mortgage rates stay high, say in the high 6s or 7% range?
This market, SF and Northern California generally, will continue to be severely demand constrained. There just isn't enough purchasing power to absorb the rising inventory.
Which means prices likely keep dropping.
As a direct result, yes, we're very likely to see prices continue to drop. The pressure from high inventory and low demand creates this ongoing downward force. But it's also really important for you, the listener, to remember these drops aren't perfectly uniform.
Right, it varies locally.
Significantly, the amount values decline, the current trajectory, it can differ city by city, neighborhood by neighborhood, even zip code by zip code.
So the overall trend is down, but there are pockets.
Yes. Some areas might still see significant downside ahead. A few very local micromarkets might even be showing early, tentative signs of stabilizing, maybe even a tiny recovery. It's complex.
It highlights the need for that local data you stressed.
Absolutely. For you, whether you're buying, selling, investing, the takeaway is clear. Educate yourself deeply on the detailed, hyperlocal data for your specific area.
Don't just assume the broad trend applies everywhere.
Don't assume anything. Dive into the granular data. It's essential for making smart decisions in this volatile, evolving environment. Your success really depends on your depth of understanding.
So wrapping this up, what does it all mean for you, trying to navigate one of the country's most watched, most expensive housing markets?
Yeah, let's summarize the key points.
We've seen this unprecedented surge in inventory across Northern California, especially the Bay Area, doubling in 2 years, highest levels in nearly a decade.
A huge supply shock.
Coupled with a dramatic collapse in buyer demand. That combo of million-dollar-plus homes and 7% mortgage rates created a severe affordability crisis,
Pushing most buyers out.
and this has led to a steady, sustained correction over the last 2.5 years. Significant price drops in many counties, challenging that old myth that Bay Area values only go up.
Debunking the myth, yes.
It really is a classic case of supply and demand playing out, creating opportunities for some, maybe.
Potential opportunities, yes, if you can afford it and navigate the risk.
But definitely increased risks and anxieties for sellers facing a much tougher landscape. Those days of easy sales and soaring appreciation, they're gone for now.
Firmly in the rearview mirror, as you said. And if we connect this to the bigger picture, what we're really witnessing is a market undergoing a profound and probably necessary rebalancing.
An adjustment after years of crazy growth.
Exactly. Painful, but maybe essential. The historical volatility we know exists here, combined with today's severe affordability issues, it strongly suggests we're in for a period of considerable prolonged adjustment, not just a quick dip.
So not necessarily a crash like last time, but a longer, slower grind, perhaps.
That seems plausible, yes. A significant reevaluation. Which brings us to a final, maybe provocative question for you, the listener, to think about. As these markets realign, as the sheer cost of ownership stays so high, potentially permanently for many,
Yeah.
what long-term changes might we see in how people live, how they work, how they even define home in one of the world's most dynamic and expensive regions?
Interesting point. Will renting become even more dominant? Will we see different housing models emerge?
Could we even see a gradual but significant shift of population away from the Bay Area? This correction isn't just about numbers. It could be a harbinger of deeper, more enduring societal shifts that redefine this region for decades.
Definitely something to keep an eye on. Food for thought.